Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for October 4th of 2021. Please see our disclaimer for important information. As we get started in our analysis this week, a couple of charts that really stood out to me and have, frankly, for the last couple of weeks. Here on the left-hand side, we've got our COVID tracker, which you can clearly see now is in a decline as far as our 7-day moving average for daily new positives. Now, death rates, daily deaths, I guess, are continuing to rise, even though death rates are extremely low. This coming from our friends at First Trust, who's analyzing data out of the CDC. And also from First Trust on the right-hand side is something I thought was really intuitive here. And this is basically the R naught or RT analysis. And this is just a measure of transferability of the virus as it stands right now, as of essentially September 27th. So maybe a little bit of a lag, a week or so, but you can see that most of the country, with some rare exceptions, we have clearly below 1. And so this means that the rates are in decline, which should dovetail with what you see in the blue line on the left-hand side, is that caseloads are coming down, that we're seeing this delta wave, if you will, begin to roll over in a meaningful way. Again, we always guard against false trends that you don't want to see this thing tick back up, and we are heading into the fall and getting into some areas of the country where temperature is going to be low enough where you typically see flu season pick up. But as it stands right now, it looks like we're trending in a fairly good way insofar as the virus is concerned. Here's our high frequency data from our friends at First Trust, and you are beginning to see this new trend with the Delta wave beginning to ebb a bit and more activity beginning to transpire. You can see a lot of green on this page, especially on the week over week open table, TSA checkpoint, commercial flights, motor gasoline sales. Things like that are trending up on a week over week basis. Month over month, the only thing that really from kind of the key indicator standpoints are the motor gasoline sales are a little bit down, about 2%, but you can see versus 2019, which is third column from the right, you can actually see that gasoline sales are up over 2019. Now, obviously the other data, if you talk about hotel occupancy, down 11% from 2019 levels, open tables still down about 8%, TSA checkpoints down around 24%. We are narrowing that gap, and that's very positive. Rail car traffic, we've seen little fits and starts in that data, but again, over the last month, on balance, pretty positive as we see manufacturing data still trend upward. I saw this chart from the B of A Global Investment Survey, and this is U.S. private sector financial assets as a percent of gross domestic product, or basically private sector financial assets, not including real estate, as a percent of the economy. And you can see that this trend has been evolving very much, particularly from 80, when we started to see around the time that we started to see interest rates crest and begin to roll over, and we enter this secular bull market in fixed income and interest rates, you can see that this percentage has continued to go up with a little bit of interruption here and there. We've hit obviously a couple of recessions in 2000, 2001, and then 2008. But that number has really rocketed higher. So we have a lot of equity ownership at the retail level, at the consumer level, and this also includes other financial assets like currencies and deposits. And we know consumer balance sheets are in really strong shape right now. Mortgage rates being low, and a lot of people having refinanced and having a lot more liquidity than they have had in the past. Pending home sales, real quick check-in here. We've been monitoring the real estate sector, and pending home sales are trending higher in the last data point, which is, I think, a positive in the sense that we know that the residential real estate sector still has legs, even though we begin to see little pockets of softness. And really what that represents is that we're coming off of our peaks for the time being, but the market is still clearly growing. We still see in the pending home sales numbers positive trends. This is a quick look at the unemployment insurance benefit, and you can see here, I first caught this in a Liz Ann Saunders tweet that she was referencing this, and that last data point on the far right represents a clear departure from this overarching downward trend that we've seen here over the last 18 months from the peak of the pandemic. What that represents is a cessation of the supplementary unemployment benefits. And so that this has clearly had an impact on the insurance benefit that have been paid out. In fact, it's less than half of where it was in the previous data point. So we're clearly seeing a trend in this, and hopefully the expectation is to some degree that it's going to help inspire people to move back into the workforce. This is a plot of U.S. durable goods new orders, okay, against capital goods, non-defense, excluding aircraft. And in both cases, you see this moving a lot higher. You know, this has really been, in many respects, the fuel behind the fire. I mean, capital goods demand has been really strong, and even if you exclude non-defense or defense items and aircraft, you know, they're looking exceptionally strong. Now, this has obviously had some influence too into these supply chain choke points that we continue to face and are likely to continue to see well into next year, simply because the demand equation resolved itself after the peak of the pandemic a lot faster than anybody could have ever imagined, at the same time that manufacturers were continuing to deal with the pandemic related issues concurrently. This is an interesting chart that comes out of Goldman. This on the left represents a plot of unfilled orders in these various categories, right? So furniture and related, motor vehicle, computers and electronics, household appliances. You can see, you know, the unfilled orders are moving higher and higher, and this has a lot to do with the supply chain choke points. And on the right-hand side, you see capacity utilization and relative to a pre-pandemic range. And so what this means is that, you know, there was obviously a range of capacity utilization in each of these categories before the pandemic. And where are we now? Well, with the unfilled orders that you see on the left, all trending higher. You do see the flattest line in that group is computers and electronics, but it's been a pretty steady demand. We've just seen a real spike in some of these other components, household appliances being very notable in that group, and furniture and related products. And anybody who's, you know, ordered you know, a large appliance or furniture knows exactly what I'm talking about, because it's taking forever to get to you. But as you can see on the right-hand side, capacity utilization is moving higher, with the exception of motor vehicles and parts. But, you know, we're still in that channel that we saw pre-pandemic. We're at the highs, computer electronics, appliances and furniture. Again, 70 to 80% capacity utilization. It's certainly at a level that you would expect to see more capital spending. So this is good. We're going to have additional capacity coming online to help fulfill this demand and these unfilled orders. And I do think it's going to have a net benefit when we get to a point where some of these supply chain choke points kind of resolve themselves, if you will, and we'll have that kind of delayed impact of this demand hitting the economy. Here's a quick look at exports, and you can see that number really looks good and continues to move higher. So these are, despite the fact that we've got a higher U.S. dollar, which typically does not correlate as well to higher exports, but there's clearly a lot of demand overseas. And even if there is a valid argument to be made about overall conditions not being as robust in particularly Europe, but also Asia right now with some of the shutdowns that they've had with regard to the pandemic, it's still really good to see that U.S. exports in general are moving higher. And here is that U.S. dollar that we were talking about. And again, this time series just goes back to right before the pandemic. You see the shock there in April of 2020, and it's been moving down ever since. Now, if you basically move 1 year ahead, we really kind of troughed in April and May of this year, and we've been moving higher ever since. And the dollar, in fact, has seen a bit of a spike here as of late. And so, the thought here on the dollar, even though we saw this in the last chart with exports moving higher at a time where the dollar is moving higher as well, and what that means is that a dollar strengthens those exports. The countries that are importing our exports are essentially paying higher dollar prices for these with a dollar that's increasing in value. As these economies overseas continue to grow, and I think an argument to be made in 2022 is that perhaps foreign markets wind up growing faster than the U.S. market, that you can actually see their currencies appreciate relative to the dollar, and you can actually see maybe a dollar decline from where it is now. This is the inventory sentiment. Again, goes right back to this whole issue of supply chain disruptions. And we've seen the unfilled orders, we've seen the demand in these areas, and where this choke point is really manifesting in those 4 key areas a few charts ago. And what this shows you right here is that the inventory sentiment, and this is a survey, right? And it's basically, kind of a compilation of several different questions that are being asked manufacturers, and so and it's relative to the total number of reports that mention in inventory or supply, and the sentiment index is really negative right now. And this is a function of businesses really frustrated with the supply chain choke points and saying, listen, I don't have as much inventory right now because conditions are bad, because either I'm missing one component that I need to complete this product, or I can't even get started on it because of raw materials constraints. So we'll want to see this begin to turn up before we can really begin to feel comfortable about the inventory boost to economic growth in the quarters ahead. Now, as we kind of pivot towards a brief conversation about inflation, this is a mention in S&P 500 companies citing inflation increases. Now, we're about to get a whole lot of third quarter financial reports from S&P 500 publicly traded companies here. But at least in this void of financial information where there are pronouncements, there are pre-announcements, there are interviews and presentations and things like that, we can get a sense of maybe what CEOs are thinking. And we know that the mentions here are moving higher. And you can see that 2Q of 21 over 1Q. So again, this is looking at it in 3-month snapshots. And so, last year, pre-pandemic, a lot of mentions. During the pandemic year, not so many because we were worried more about deflation. But that ratio has consistently moved higher. And actually, not a ratio, but more of an aggregate number of companies that are talking about inflation. And you can see here that that this number continues to move higher. And frankly, I would expect to see this number continue to trend upward here in the third quarter. Again, on the inflation theme, we've got a couple of things that we want to talk about here. On the left-hand side from BlackRock is essentially in kind of the orange line, you see small businesses that have announced their intention of raising prices. And we've seen this in our charts of the week here in recent memory with the National Federation of Independent Business Surveys on this very same topic, you can see that number's moving higher. So small businesses are not only have the intention of raising prices, but they are raising prices. Now, and that's plotted on top of U.S. core CPI, or the Consumer Price Index, which is, again, core inflation. It backs out food and energy, which are much more volatile. You can see that number is also trending higher in the yellow. And just one data point from one research house here, you've got BlackRock CPI estimate is looking out on the horizon and plotting about 3%. And I think that's very consistent with a lot of opinion out there. You know, whether it's 2.5 to 3 or 3%, you're almost splitting hairs. But, you know, most of the research firms out there are kind of coalescing not only on the notion of having higher inflation that we've had in the past, but also coalescing on, you know, this range of expected future inflation of somewhere between 2.5 and 3%. And what you can see on the right-hand side is really just this manifestation of everything that's going on. This is private capital equipment prices. So, you know, we talked about a lot of industries, businesses, you know, engaging in capital spending, or at least planning to help expand production capacity, you know, internal infrastructure, those types of things. And those prices are moving up. So we see equipment prices overall moving higher as a result of, you know, this dynamic that we're facing in the market right now. And so this is contributing, you know, to inflation, and it's also a manifestation of what we're seeing in the production pipeline. Now, as we kind of transition away from maybe producer prices to some degree and consumer prices, let's kind of drill down into a major component to this. And this is, you know, on the CPI, the core CPI, you know, owner's equivalent rent accounts for like 40% of this. So again, it's not what the Fed looks at, but it's what's published in the financial press. And this is what, you know, the media really focuses on, is Consumer Price Index, CPI. So if you look at the left-hand side, you've got owner's equivalent rent year over year. It's been pretty benign, but it is fishtailing up. It's moving higher, and that typically moves at a lag to house prices. And that's why I've got both of these side by side. So on the left-hand side, that black line represents owner equivalent rent year over year. It really hasn't done much, but it's beginning to turn upward, right? And then the red represents the median asking rent in the US. And so that has already moved higher off of kind of interim trough levels that we saw last year. If you go to the right-hand side, you see obviously what house prices are doing. And the gray line represents the Case-Shiller House Price Index, and it's being pushed forward 14 months because, like I said, housing prices typically operate in advance. Well, let me say, better stated, rents typically follow house prices. And so if you push forward that house price index about 12, 14 months like it is here, you know, you can see why in both the kind of the orange or gold, if you will, and the blue, you can see owner's equivalent rent and primary rents both beginning to tail higher. And so I would expect that this part of the inflation picture to continue to evolve here in the certainly in the months ahead, but I think become a topic of considerable conversation over the next 6 to 9 months. Well, before we kind of conclude our conversation of the international sector, got a few charts here. There are some cross currents going on the global stage, and on the upper left-hand side, that represents both developed markets and emerging market economic surprise indices, and those have tumbled. And of course, they've done the same thing here in the U.S. And so usually when they hit a trough like this, you can see the kind of this, you know, sine wave, if you will, of up and down, very cyclical, that we're at a point now where one would expect the economic surprise indices to kind of flatten out, maybe even turn upward, because the expectation level is actually, gone down so much that, the thinking is that, you can't really have any more negative surprises when you're already expecting things to be weak. So that would lead me to think that we're set not only in the U.S. but on the global stage for some better news out of economic surprise announcements, or the surprise that emanates from these announcements. Now, I kind of reprint what we saw in a couple charts ago, global goods exports. And so, again, this is not U.S., but this is the sum total of global exports. And it paints the same picture that we saw in the U.S. I mean, those numbers are rising. Volume is increasing. It's above where we were pre-pandemic, which is good. We like that. There's still a lot of unfilled orders in the global pipeline because of all the same reasons that are impacting U.S. manufacturers. Now, on the right-hand side, which is interesting, so if you look at the credit impulse, and this is coming to us from Macrobond, and what it tends to suggest here is that maybe manufacturing is going to soften up because of the relationship between credit availability globally and the manufacturing index. So with credit not being as plentiful, even though we've got exports that are high, even though we're going to probably have better economic surprises, more positive surprises on the horizon, you still have this data that would tend to suggest in a vacuum that perhaps we're going to have lower manufacturing overall. And I think the global manufacturing backdrop is going to be really important to what happens here in the U.S. and obviously the opportunity for U.S.-based firms that do business internationally over the next 12 to 15 months. So even though credit seems to be tighter overseas, you would hope that begins to open up a little bit when the opportunity, as these emerging opportunities and growth opportunities present themselves. Here's a plot. Again, I saw this from another tweet from Schwab and Liz Ann Saunders, and it's her observation, so I'm just repeating it. And I thought it was really kind of interesting that here in the blue we've got the jobless claims index, and we have seen a bit of an uptick. We saw that in our high frequency data. Again, we're on a very low level, so it's not something that I spend a lot of time really worrying about. It's just symptomatic of a labor market that's not moving as fast as it has over the last several months. But interestingly enough, in that red dotted line kind of plots, that point where jobless claims trough against where, we saw the peak in the S&P 500. So, I think these are maybe coincident type indicators, but you're seeing the S&P roll over a little bit and go into a bit of a correction at almost the same time that we saw the trough in jobless claims. I wanted to describe this. This is a somewhat busy chart, but basically the red on the bottom represents drawdowns, and what the blue line represents up top is the S&P 500 index. And as you can see, coming out of the pandemic that troughed here in March of 2020, we've had a mostly linear rise in the market. Now, there have been some interruptions, and you can see that when those red areas exhibit themselves, that means that the market has corrected a little bit. Not in the classical definition of correcting 10%, but it's just gone down. It's shown a little bit more volatility. You can see that, basically from November, we really haven't had that much volatility, and what we've seen here recently is basically as much volatility as we've seen really since last fall. And it's very atypical to have a market in which the majority of a year, you don't really see a 5% drawdown. And if we extended this time series out a lot longer, I think what you would see is clearly a lot more of those little red downturns along the horizon. So again, we haven't seen a lot of drawdowns. It's healthy to see them a little bit more than we have. But to put this in context, I mean, this drawdown is not near as significant as these others. And with the risk headwinds that we see in the market, which coronavirus, the Delta wave is kind of ebbing a little bit. Inflation, I think, is a real concern and bears considerable monitoring here. And again, there's the usual geopolitical type thing. There's a risk of a policy mistake. We're still debating. We've extended the funding of the federal government for at least another couple of months here. But we still have a debt ceiling issue that we need to address. And also, we've got huge trillions of dollars of potential stimulus to argue about in Congress right now. Now, we've been talking about this for some time, but this references the fund flows into stocks versus bonds, and really bond fund flows have really continued without hesitation for many years, whereas we've seen fund flows into equities kind of begin to crest in January of 2019, and certainly by the time we got to the pandemic, it was already well rolling over. And we've just now seen, some significant, this year, 2021, we've seen that number turn back up. That's the orange line here for cumulative funds into flows into equity funds. At the same time, total fund flows, total injections of liquidity into the market continue to move higher, but most of those injections have been into bond funds. Now, as we continue the conversation about volatility, maybe picking up a little bit here recently in the equity markets, one thing that is worth noting here is that you have a lot more retail investors, and you've got a lot of you actually have an increase in the amount of option volume as measured by notional shares, like notional traded activity. In fact, that number has now eclipsed the amount of stock shares that are traded on an annual basis. And so, in this chart, when you talk about single stock option trades, they're really talking about the small investor. And so, all of these trading platforms are giving rise to a lot of speculation, frankly, on the part of the small and individual investor. And so, if you assume that one option represents, essentially about 100 shares or 100 units of an index, if you will, we're at a point now where the sum total of all of that is higher than the actual number of the underlying assets that are actually trading in the market. And so I think what this does is potentially contribute to future volatility. Again, this is not something that happened over the last 6 to 9 months. I mean, it's been well underway prior to the pandemic, and it just seems to be accelerating from here. All right, now we've talked about value versus growth, style within the S&P 500, and here you can see basically the price to earnings ratio of growth, and subtract from that the PE ratio for value. And you can see that growth with its appreciation, even though it kind of gave way to value a little bit earlier this year, it's still much, much, much higher than value. So basically the PE ratio for growth stocks in the S&P 500 are much higher than the PE ratio in value stocks. And that gap, if you look at that ratio going all the way back to the beginning of the century, has typically been a lot lower, even though it's been moving higher for the last several years. So if you look at it from that time frame, I mean, value does seem to be undervalued relative to growth right now. This chart from Bank Credit Analyst, or BCA, kind of amplifies what we've been talking about a little bit with fund flows that have increased into equities and more individual ownership of equity assets and financial assets in general. This one's really interesting. It gives you two different looks at this. So equities as a percent of total household financial assets has been moving higher for really the last decade, and it's accelerated here in the post-pandemic environment. And in fact, it's a level that we haven't seen in forever. Basically, we got close in the late 90s during the dot-com bubble. Obviously there were a lot of, even back then, we didn't call them meme stocks, but a lot of meme stocks like pets.com that everyone felt like they had to own because everybody thought we were in this new normal. Well, that bubble burst. But we have eclipsed that level here in the last couple of months, equities as a share of total household financial assets. So it goes to show you that, with increases and improvements in household balance sheets, that a lot of the surplus liquidity is being channeled into equities, and that's why you're seeing that spike. Now, if you go down to the bottom, you've got business ownership as a share of total household financial assets. And so, this ratio is a little bit different, but it's targeting, business entities. It's targeting, direct shares of operating entities and whatnot, and that number is moving higher too. So this is very symptomatic of an environment where liquidity is trying to find a home and trying to find the highest and best use. And these two areas, equities and then business ownership, both benefiting greatly from this trend. And not to belabor the point, but equities are now clearly at a record percent of household net worth. And what's interesting here is, that number we just saw, but the number that's overlaid on this is real estate. And so real estate holdings as a percent of household net worth have really kind of taken a back seat, honestly, over the last decade. And it was always a traditional response in the financial planning world to say, that real estate, as in your homestead, typically was your most important asset, and it's still very important. But what we can clearly see here in the last decade, and particularly in the last few years, is that equities have really eclipsed real estate as in its importance to the household net worth picture. Now, as we look at bond yields, I know 10-year Treasury rates are moving higher. I think that's going to influence housing affordability in terms that mortgage rates are going to be moving higher. But rates are moving higher for a lot of the good reasons, the reasons that we want, because we've got economic expansion. We know inflation, frankly, is normalizing. Long-term average is about 3%, even though we've had secular decline in inflation over the last several decades. But 3%, in an improving economy is not egregious. We just haven't seen it that much. Anyway, this all ties back into bond yields and Treasury yields, and obviously there's your risk-free rate, which is your Treasury or your sovereign yield, and then you've got corporate credit that yields on top of that, because there's a risk premium. And what you can see here is that the U.S. is frankly not the only area of the world that's seeing this play out. In Germany, France, and the UK, you can see that yields are all moving higher. Again, goes back to my comments about there being a global expansion, maybe uneven in spots, maybe not clear that all areas, are going to necessarily benefit, certainly in the same year. But there's this feeling, and bond markets are really good at predicting, future economic growth, much more so than equities. And, if you look at this chart, it tells you that things are moving higher. Maybe inflation globally is going to normalize at some point, and that there's at least some coalescing of global financial markets in the same direction. So we talk about bonds and yields. Here's a quick look at the slope of the yield curve. And so the bottom half of this chart represents occasions where we have an inverted curve, and we don't want to see that because that tends to, again, going back to the point that bond markets do a really good job of foretelling or forecasting, future economic performance. An inverted curve would be a clear signal that we're going to hit a slump. Well, I don't think we're doing that, but the curve had, after the pandemic, as clearly increased in slope. Obviously, you would typically see that with an expanding economy, and so we are entering a new economic cycle. So you want to see that expand, but we have seen a little bit of flattening here because we've clearly had a much stronger move, even if we haven't seen that in ultra short-term rates, because we know the Fed's not motivated to raise short-term rates anytime soon, but we have seen it in the 10-year yield more so than we've seen it in the 30-year yield. And so that's where we're getting a little bit of flattening here as of late. But this time series goes back a long decades and decades, and it just shows you in a relative sense where we are. And so it's not, I wouldn't take from this, the risk that we're going to go into a recession anytime soon. It just shows you that we're still relatively early in this cycle. So a lot has been made of the size of the Federal Reserve's balance sheet and all of this liquidity that's been engendered through the asset purchases that are now being discussed that they might taper those asset purchases. But this is very interesting. So if you look at the Treasury market, and just like we said a minute ago, that 10-year Treasury yields have moved higher as of late, more so than the 30-year yields have moved. But you can see here in the left-hand side that in that 10 to 20-year maturity category, the Fed owns over 50% of that new issuance, in general. So the Fed controls a lot. So this is what's important in this conversation about tapering and the necessity to do this right. On the right-hand side, you can see the size of their balance sheet relative to the size of the economy, and we know that's moving higher. And we know that money supply, which has moved higher, is now beginning to roll over again. So we're not increasing the money supply as much as we have, but the fact that the Fed owns a considerable amount, anything over like a third, is pretty meaningful. And so when you stop buying those assets, then that is going to likely have an impact on the market if you either signal it wrong or you make the change rather abruptly. And the market will read that, and you'll see a move in interest rates. So right now, there's been a steady demand for supply, and so that drives prices higher and keeps yields lower. And when you reduce that demand, then the opposite occurs, and that's where you get these higher interest rates. So it'll be really important, especially in the 10-year, which also serves as that benchmark rate for mortgages, that the Fed does this the right way when they do begin to taper the asset purchases. And looking at corporate credit, we're spending a little bit more time on the fixed income markets because these two areas have done extremely well this year, where the overall bond market in the Barclays Aggregate Index is negative for the year. Both high yield and senior secured loans have done exceptionally well. They're very, mid single digit positive. And so, and this is also telling with regard to what the sentiment is on future default rates and future, economic performance. And the read through on both of these charts is actually very positive. So if you look at default rates, both on high yield and senior secured, way down. In fact, lowest levels we've seen really in almost a decade, and are retouching levels that we've seen a couple of times this decade, but get exceptionally low. Now on the right-hand side, we've got distress ratios, which have some nuances to them, where it shows like declining interest coverage ratios and things like that. And again, those are also very low. So in both of these charts, the key takeaway here is that there's no expectation whatsoever that we're seeing stress in the corporate credit market, which is good. We know a lot of money is flowing into that area, so it's in no way kind of foreshadowing perhaps any kind of a recession type atmosphere here in the coming year. High yield bond spreads, again, another indicator of really the bond market's interpretation of a relatively strong economy. Spreads between U.S. Treasuries and corporate credit are really tight. What does this mean? This is essentially the difference in interest rates or yield from a corporate credit, kind of an average corporate credit, and the U.S. Treasury. So right now that's kind of saddled around 350 basis points, or 3.5%. And again, this is as low as we've seen this in quite a while. Loan leverage and interest coverage. We don't see a lot of stress here either. Again, these are all read-throughs on corporate credit over the last few charts here, and the takeaway is really positive. So black bars represent interest coverage. So as we see those black bars increase over time, that tells us that interest coverage, or basically the ability for companies to cover their interest, is improving. At the same time, we're actually seeing some decline in overall leverage. Cash flow surpluses are enabling companies to not have to take on as much leverage. And this isn't really, I'd say this is looking at the broader market, if you will. It's not looking necessarily at publicly traded firms, but the broader market. And as you can see here, the overall level of credit is dropping off at the same time that the ability to pay your interest on existing debt is increasing. And finally here, we've got a quick look at really mobility and the future of work and everything that is being discussed right now with regard to the office market. And you can see here from Markham, which is a consultancy, their survey on on companies offering employees the opportunity to work from home or work remote, and you can see that there's a really strong response here. So, this notion of working remotely, out of necessity during the pandemic, is giving way to a real and tangible desire by employees to want to work home in the aftermath of the pandemic, and also the willingness of employers to offer that option to them. And you can see, that those responses are reflective of that. And on the right-hand side is just really a manifestation of what the survey results kind of suggest on the left, and that's that, over the U.S., which is in that gray, visits to U.S. workplaces versus a pre-pandemic level are still at least 30% below where they were. So not terribly surprising, but I think it's, we're seeing a real trend emerge in a mobile, remote workforce in a lot of cases. And I think that does have these implications that we're going to have to watch with regard to office construction and the continued maybe flight, if you will, of employers out of the urban core and into the periphery and the suburbs. We'll have to continue to monitor that. Well, that's all we've got today on behalf of the entire team. I hope that you have a wonderful week, productive week, and we will talk to you again soon. Take care. Goodbye.